Welcome back to another episode of the Brutally Honest Loan Officers Podcast. I am Derek Brown, and with me is Stephen Brock. Stephen, say hi.
Hi, everybody.
What's going on, man?
Living the dream. Maybe a little bit
Whose
of
dream?
night.
Is it your dream or is it
Yeah.
just somebody else's dream?
Yeah, somebody else's dream. It might be a little bit of a night. I would say nightmare. I mean, the market is a market, but we're gonna go over like what is happening with the market currently in the mortgage world. So
Yeah. If you know anybody in the mortgage market or in the mortgage business, they might have had a bad week last week. We've talked about market volatility and that, interest rates are kind of going up and down. We think eventually they'll come down. We're kind of following inflation. And then last week, we just got punched in the face by inflation. And I'm sure a lot of consumers may not know this, but anybody that was buying a house or might have been pre-approved and looking at rates, between Monday and then Friday last week, there's a significant jump in interest rates. So
big
we're
time.
gonna kind of talk about what the hell happened.
Is this I think this is the biggest rate jump I've seen in a couple hour period.
And yeah. I mean, in a matter of hours, I had a half point increase on the
Yeah.
interest rate itself. If you're looking at the rate, if you were at like 699, you for the same cost, or if that was your par, whatever, you were then at like 7.5.
Yeah.
So, and I had people going under contract. We got the contract the day after this happened, and I had to make that phone call. Like, listen, I'm not trying to do a bait and switch, but we are in a different world than we were just 24 hours ago. So, uh, I mean, Stephen, if you want to, touch on it, I mean, it starts with inflation. That's kind of where it starts.
It does.
So,
So inflation is what really drives mortgage rates. And by that, saying that the Fed wants to control inflation. They don't want it to go out of control because inflation goes out of control, the economy basically sinks. Um, so with them controlling it, they control that overall arching what the bank to bank and all that can lend at and what that rate is at, which trickles down into the mortgage world. Now, people are like, well, the economy is not doing that well right now. And the data says otherwise. And I always tell people like go out on a Monday night to a restaurant and that restaurant is packed. So the economy is doing just fine by those numbers on it. Now you can get to nitty gritty. Is it people just racking up credit cards because we have an ultimate high of credit card debt in this country right now? But the fact is people are spending money, jobs are being created. So that means inflation will continue to technically rise. So the Fed is holding down on keeping the rates where they're at. They have not said they're going to raise them at all, but it does not look like what were the predictions? Some people were saying like, oh, they might lower it 6 times this year.
yeah, first thought was maybe a rate cut in March,
Yeah.
then a rate cut in May, possible rate cut June. Or they basically at the beginning of the year, we thought there would be 3 rate cuts from the Fed.
Yeah.
And right now we're praying that we might get 1.
Yeah.
So everything's just kind of been pushing back. I mean, like you said, starts with inflation. And yes, consumer debt is out of control, but unemployment isn't.
Yeah.
So when we're looking at unemployment numbers, that hasn't gone up significantly. If unemployment numbers start rising, then we would see a drop in interest rates. That's not happening. And a lot of these reports will get revisions later, and sometimes that helps. But it's just those initial numbers. One of the things, like oil prices, is hurting us. And I don't see that helping anytime soon. So yeah, I mean, it's really affecting interest rates and then affordability, like especially housing affordability, because home values aren't coming crashing down. If a $400,000 house came crashing down is worth 250, and that's what you could get it at a 7% interest rate, well, then that's not that bad. I'd rather do that than purchase a $400,000 house at a 5% interest rate. So it's last week was brutal,
It, you know,
and
it was brutal, and in a sense of watching it jump, like what you were kind of talking to people one day, and the next day it completely changed.
right,
Um, and so you got to go back and have these conversations. I mean, you're reworking the conversation. I tell people the market is the market. It is what it is. There's not you cannot do anything individually, even a group of people do anything about it.
right,
It's a tough conversation to have. Hey, you were able to buy a $500,000 house. Now you're buying a $450,000 house is what you. Um,
right.
so it can be a shock to people. And I have people ask me like, well, it went up. What I also think is that there's going to be a lot more consumers now coming back to the market because
Right.
they were all waiting for, oh, rates are going to drop, rates are going to drop. Like we said, we were thinking three, people were predicting, national economists were thinking anywhere between 4 and 6, and you might have one now by the end of the year. It's like the prediction.
Right.
So people are
I
like,
think you might see one before the election. The election
yeah.
is what, November? So we might see September, maybe July, depending on inflation, unemployment, all the other factors.
If these numbers
Um,
keep coming out how they are, they're not lowering it at all. So I think it's
right,
getting a lot of people basically off the fence. They're like, well, it's not coming down, but house prices are going to continue to rise because of basic supply and demand. So they're
right,
like, I'm going to go buy a house. Like it's time. Their only waiting factor was, hey, I'll wait for rates to drop, and it's like, well, that's not happening. So let me go and buy the house. So I've actually had an increase of people wanting to buy now. I mean, they still get this the shock of the rate. Like, oh my gosh, like that's what the rates are. But that
right.
shock of that rate is because you know 2 3 years ago you were in the twos and threes. So that's what it.
Well, and it's hard not to compare,
Yeah,
So when you've got one of your friends that bought a nice little house that was $260,000 and their interest rate was 3, and they've got, a $1,200 mortgage payment or whatever that might be. Now that house is worth 350,000 and the interest rate's 6 or 7%, and they're looking at, a $3,000 mortgage payment. They want to sit there and be like, well, that's not fair. Well, you should have bought 3 years ago. I don't know what to tell you. And I don't want to like be negative like that, but that's the difference. You can't compare to what somebody did, a couple of years ago.
yeah,
So what you can do is look at what you're able to do now. Um, you know, I think one thing is setting expectations for buyers and sellers. Um, Understanding the market. Last week with interest rates jumping up, every single time I talked to, like, we got 3 contracts in, and talking with those 3 buyers. Well, Derick, do you think interest rates are going to come down? I think we might get a little reprieve, and we did kind of see a small amount of reprieve Thursday, Friday, just the settling of the inflation reports that came out. But we haven't seen a huge drop. But I also didn't want to float interest rates. So I said, we're going to lock now because that just creates a worst case scenario. This will be our worst case.
yeah.
If we're within 15 days of closing, like our company has a float down policy. Some call it a rate renegotiation. But when we're, getting closer to closing, if the market's adjusted and gone down, we can drop our interest rate. So we've got that in place. So there's really no point in floating the interest rate and like risking it getting that much worse.
Yeah.
So, I mean, we locked everybody in, and hopefully, there might be a little reprieve later on. We can do a float down. Otherwise, at least we know what the worst case is. If you're looking to sell a house right now, I would say be prepared to have buyers asking for seller paid closing costs, or the seller paying the buyer's closing costs. Because what we're doing with that is either saving some people out of pocket expense, but a lot of time that's blended in paying points for a lower rate to help get that lower rate without it being an expense to the buyer. And it it feels better when you're not paying that much in points.
And what I also want to look at is, so if I'm looking at, I just brought up the bond market.
It's
We
not so pretty today either.
And it's not so pretty today. It's still kind of hurting from what it happened last week. But so October last year was I want to say our highest rates were coming out around then. That's where
Right.
the bond market was at its lowest. And explain this, that when the bond market is low interest, when the bond market goes down, interest rates go up, and then
Right.
when the bond market goes up, interest rates go down.
Right.
So, October, trying to click where the lowest was like 96, and we're at right now 99. So you think about that, like it's a pretty far spread in between of what that it was. So we're definitely still not as bad as we were then, and not even close. So I mean, trying to think, hit a kind of a
Not
low
as
in
bad as it
August.
was.
No, so I mean,
Not as bad as it was. It's a little better than, what we've seen in most recent months, as far as when I think it was October that we have, just highest interest rates that you and I have dealt with in a while.
yeah,
Um, and I don't know if anybody's following the news, but there's some issues going on between Israel and Iran that involve the US. That's going to affect,
that's probably what
yeah,
you're seeing today.
yeah, because that's going to affect oil prices. Oil prices are major contributing factor to inflation. You think if oil prices go up, every single, like anything that moves takes oil. So you've got delivery trucks bringing goods and services, whatever. And then planes, they move people, like everything. If oil prices go up, everything's going to get a little bit more expensive. So that's probably what's happening today. If here's a little trick too, because you can go to Yahoo Finance or you can just Google 10-year treasury yield. And if you Google that and it's going up, interest rates are going up. If it's going down, the 10-year treasury yield, if it's going down, mortgage interest rates are likely going down. That's just an easy little peek at, if you're trying to follow the mortgage market, I would do that. Look at that, and you can see we've got tools that connect us with MBS and stuff like that. So we can see, a little bit more specific of what's happening. But that's a great little tool if you want to just take a peek and try to get an idea of where the market's heading. But you'll see it on a daily basis. I mean, it adjusts minutes, hours, every day. So
Yeah,
don't think that you saw something at 10 a.m. and it's going to be the same at 2 p.m.
no, it's every minute. It's the stock market. I mean, if you just think about stocks, that's exactly what it is. You're just going to see it up and down, what they're
Right.
going there. So, um, I to me still is the market. We can't control it. It's your personal choice, or personal, I guess, personal decision of when, and how you buy it.
Right.
You know,
Well, we touched on affordability. You might want to buy a $500,000 house, but depending on your debts and what that mortgage payment would look like and stuff like that, we don't want your debts and your mortgage payment to equal 50% of your income. That sucks. That sucks. That makes it harder to save. It makes it harder to invest. It makes it harder to take a vacation. Don't do that. Don't do that. If I don't know, and we've done it a couple times. We'll do it when people are adamant. And then I've also had it where we might be using one borrower's, or let's just say we have a husband and a wife, and the wife works, but maybe she's self-employed and we're not trying to use her income, or she doesn't claim as much as we want. So we just do everything based on the husband. We can stretch that DTI a little bit, and I might be more comfortable approving somebody there, knowing that there's more income in the household. Otherwise it's just smarter to reel back, and purchase something that's a little bit less expensive. Just for the affordability issue. I don't know. And I'm telling you right now, it's hard, because I know that we bought a great house in 2017 and it was perfect for us, but it was definitely not our dream home forever. But it was a smart move that we made. And we bought in an HOA. It appreciated over the 6 years that we lived there. We paid down our mortgage balance. It was a much better position than if we were to just be renting.
Yeah.
So for us, that made sense at that time. My income, my wife's income, both also increased, within that 6 years, which made everything just that much easier over time. So I don't know. I don't want to tell somebody like, I think one of the phrases that we've heard too is marry the house, date the rate,
I hate that
fire
phrase.
the landlord. I hate that phrase so much because if you think about it, marry the house, date the rate. Somebody that bought last year and is just dating the rate, you're in an ugly relationship for a while because interest rates have not come down like where you can immediately refinance. So I just, anybody that is thinking about purchasing right now, but then also thinking I can just simply refinance in 6 months, you have got to get that out of your head. Do not plan according to that scheme.
Yeah.
It's because it's too unpredictable. And I do not see anyone doing a rate and term refinance in 6 months in order to lower their rate and save money then.
Yeah.
I'm not sure if you're going to be able to do it in 1 year.
The refinancing
do I think that in the next 5 years? Yes, I would think that eventually we will get ahead of inflation and that refinance opportunity will be here.
And
but
I mean,
there's no crystal ball.
The inflation it's not, to me, it's not necessarily, it's not out of hand. The Fed is just letting it run its course right now of, okay, we did all these rate hikes and we controlled it. It's not spiking up. Now, would they want it to report lower than it's reporting? Of course, that's the whole point of it. But it's not like it's reporting so high from what they're predicting.
Right.
So it's pretty close. I mean, if it's 1/100th off of what they're predicting, the market goes into frenzy because it's not what they predicted. So it's not that it's necessarily out of control. It's just not coming down as fast as the Fed wanted it. Or I don't even say the Fed wanted it, as third-party onlookers, as mortgage people, as economists, like, hey, it should be here. And it's just not. It's not there yet. Part of it is, the job creation is still happening like crazy. People are spending money like crazy. So it's not going to come down as fast. And it's not a bad thing either. I mean, it sucks for anybody like that's looking at mortgages. Like, yeah, it's higher than it was 3-4 years ago. Of course it is. But that means if they're still trying to fight inflation, that means the economy is still producing very well.
Right.
That there's income to be out there. Like I said, I mean, there's people spending money left and right. Just go to, off hours shopping, not in peak times, and there's a ton of people out there shopping still.
Dude, we had a birthday party yesterday and saw one of my friends. I'm not going to say his name, but he went to the Masters this last week. My man spent $1,600 at the clubhouse on like shirts and hats and some stuff. $1,600. And he said it was packed. There were a ton of people in there spending a ton of money. We went to the Orlando Science Center. That's where the birthday party was yesterday. It was packed, and guess what? Cost money to get in there. We tried to go out to dinner last week, and we ended up going to one restaurant. Wait time was too long. We went to another restaurant, and the wait time was still long. We're like, all right, we'll just wait. I mean, people are spending money, but then when it comes to buying the house, they don't want to spend that extra money.
Yeah.
That's where I think some people need a grip, like just get a grip on some things. Your interest rate affects your mortgage payment, and the jump last week might have made payments go up just for one specific customer. Let's say it went up by $100. That's annoying. However, that's one night out.
Yeah.
That you just don't do.
Where were you going out for $100? We were definitely like,
well, if it was just my wife and I, and we didn't have an appetizer and we only had one drink.
There you go.
Or if we're with the kids and we're not drinking and we don't do appetizers and everybody just gets one meal and maybe the kids split something.
Yeah.
Be $100. Yeah. I mean, Chick-fil-A is less than $100 for the fam. But yeah, there's one restaurant that we love because they've got basically, it's called the Yardery in Sanford. Shout out if Yardery wants to give us gift cards for saying their name on our podcast.
Yeah.
But it's awesome because they've got like a big tire swing. They've got games to play, cornhole and stuff like that. And the kids are always distracted and it's great. So we can sit there and like have a drink and eat some food with friends. And it's awesome. But we don't get out of that place without spending over $100 because you add in the food, the drinks, tipping 20% or more. And
Worth every
We have
penny of
never
it.
left without spending more than $100.
It's worth every penny.
Yeah, it's worth it.
So
And I sign away like it's nothing. So I just think that that's where, you know, people are willing to spend money on things that make them instantly happy, but trying to save $100 a month on their mortgage, you know, they don't want to come up with a plan to do that.
so let's kind of full circle this back then. So what do you think is going to happen with the market? And other a little caveat, I'll answer first. Do you really care? Do you really care what happens? Because to
Yeah,
me,
definitely
I,
care. Of
I mean,
course I care.
I care to a point of if it goes to 7 or if it goes to 8, if it even goes to 9 on rates, people still need to buy houses. Now, is it going to suck for people that, you know, hey, what you could afford a while ago, it's different now? Yeah, that happens with it. But to me, the biggest things that the Fed has done, you know, in the end of 22 and in 23 is taking shape and they're controlling things. So the market itself it takes time. So now we're just in a time game of letting it balance itself out. So if you're waiting for it to come down, you might wait a lot longer than you anticipated. And doing that, you are losing the cost of waiting is ridiculous. The equity you're losing out on from just paying principal, house prices are not coming down at all. So, I mean, anybody that's listening to this that's on the fence about buying and because you are waiting for, you know, prices or not price, you prices
House
come down, but
prices in our market, we should say.
yeah. And then every market's a little different. I mean, there's probably nationally it's still going up. Now there could be pockets where things are going down, but nationally it is still going up. Um, but waiting for the rates to come down to purchase is probably going to turn around and bite you in the butt with it.
Right. I agree with that.
And if that's your only reasoning of not buying. I mean, you could have 100 different other reasons that would make more sense, but if that's your reasoning, it's probably going to bite you in the butt, bite you in the butt with it.
Right. I care because I'm tired of having tough conversations with people sometimes. And I mean, it is tough, you know, so, I mean, and I had a tough conversation with a couple that makes fantastic income, right? So their income, the combined income is like $12,000 a month. They barely have any debt and they've been saving and doing very well. And they just simply, the house that they love is going to be just under a $4,000 mortgage payment. And that sounds crazy. And they're just like, Derick, in that specific buyer situation, I would move forward because it's a quarter of your income. Like all of their debt, mortgage included with whatever, like they had one car loan and some credit cards. And I think there's one like installment loan, but either way, like all their debt added up total, I think it was 4,000. And that included their 3,000 something dollar mortgage payment. So that's a quarter of their income going towards debt. Another quarter can be saved, just simple save. The other quarter can be invested. And then you still got a quarter left. You know what I mean? Like, so in that specific scenario, you still have the ability to save. You're doing very well. You could even take some of that, pay down your mortgage a little bit faster. That takes your interest rate from being 7%. That could almost make an effective rate of 6.5%. So that's an idea. But when somebody, if they're in a market where houses are worth 300,000 and that's one of the lowest houses that they can purchase, and they make, $65,000 a year, it might be difficult for them to purchase. And that's where I wish rates would come down because it would allow them to then hopefully purchase. So that's why I'm leaning towards like, I wish rates would come down, and I do care. But also it would make life a little bit easier for loan officers too. Because last week was just an annoying week. It sucked having that conversation like, hey, sorry, we're in a different world than we were 24 hours ago. That's annoying. I don't want to say that. I would much rather say, hey, every number that we went over in this last week, and now that we found the house and we updated everything, it's the same. we're going to lock in your rate. And then we still have, our float down policy. So if things get better, it'll be even better.
Yeah.
That's just like, I'd rather have that conversation. So me being selfish, that's
You're a
kind of
little
how I'm
selfish.
leaning.
Yeah. So I think that overall, how the best way to put this. So overall, the market's trend
It's volatile.
is
It's
volatile,
volatile.
and I mean, and at this, it's unpredictable.
Correct.
I mean, so many people have said it's going to come down, it's going to come down and come down, and look, they're shifting. Oh no, now it's going to be over here, kind of thing. So I still
There's
think
not a
that,
single person out there that knows exactly what's going to happen, that can predict the future. There's people that make a ton of money, looking at these reports and trying to figure out what's going to happen and when. Nobody's been right every single time. We're looking at this. We know what to expect. The expectations, aren't hitting the mark. So, it's just, if you're trying to follow this market, good luck. The only thing we can really do is try to plan accordingly, react cautiously, but just be prepared for more volatility.
Yeah,
that's my expectation for how the rest of 2024 is going to go, with some market volatility. That's all.
if you're sitting on the sidelines waiting for the rates to come down, get off.
You might be sitting for a while.
Yep, a lot longer than you thought.
And that home that you thought you were going to buy, it's just going to be more expensive. Taxes on the property are going to be more expensive. You're insuring a more expensive home, so that's going to be more expensive. There's a bunch of different factors that go up while you're waiting. So,
well, that's the market.
That was our little market. We should probably start doing like a monthly market update.
Let's do that.
Have that.
We'll get the number. We'll do one. A couple days after this. I mean, because the CPI numbers are the big ones that really affect. That have the shift that everybody really pays attention to. So every time the CPI numbers come out, we'll do a market update. What we're seeing.
Consumer price index. For anybody listening, that's like, what did he just say? What's a CPI? Consumer price index.
Everybody's thinking CPA right now because today is tax day. So make sure your tax.
Oh yeah. If you haven't filed for an extension, you better.
All right, Derick. Thank you for today.
Hey, thanks for joining me on the Brutally Honest Loan Officer Podcast. I'm Derick Brown.
It's Stephen Brock.
Thanks for joining us. We'll see you next week.
Bye, guys.
And girls.
And girls.